All right, students, welcome to today's Explainer. We're going to rigorously analyze the systemic constraints in the policy roadmap for India's private investment cycle. As an economist, I can tell you right now, there are very few topics more absolutely crucial to the future trajectory of a developing nation than this one. We're going to look way beyond the standard headlines and unpack exactly why private capital moves, or in many cases, hesitates, in the world's fastest-growing major economy.
Here's our syllabus for today. We'll establish the macroeconomic stakes, diagnose the current data, break down 4 distinct pillars of friction, and then finally, construct a blueprint for policy revival. Let's jump right into part 1, the imperative. Why does private investment actually matter so much?
To understand this, we have to recognize that an economy simply cannot indefinitely run on the engine of government spending alone. Over the last few years, the public sector has done the heavy lifting, but to sustain high growth, private capital has to take the baton. Listen closely to this concept, because it's the absolute bedrock of economic expansion. Private investment is indispensable because it drives what we call capital deepening. This is how an economy actually scales its factories, logistics networks, and innovation. When you increase the amount of capital per worker, think giving a construction crew heavy machinery instead of just hand tools, you raise the potential output. And crucially, by expanding that productive capacity, you prevent demand growth from just triggering inflation. If we have more money chasing the exact same amount of goods, prices just skyrocket. Capital deepening ensures we're actually producing more goods to match that demand.
Now, beyond just building more capacity, we have to look at the massive job multiplier effect investment creates. It happens across 3 distinct layers. First, you get direct employment, the folks actually working in the new plants or on the construction sites. Second, you have indirect employment rippling through the web of logistics, suppliers, and ancillary units. And third, induced employment, which kicks in when those newly employed workers start spending their higher incomes, creating even more consumption demand. What's really fascinating here is that the composition of the investment drastically dictates the type of jobs created. A multi-billion-dollar semiconductor fab and a labor-intensive textile cluster might involve the exact same amount of capital, but they generate vastly different numbers and types of jobs for the broader economy. We absolutely need both, but we have to be strategic about it.
Moving on to part 2, assessing the current evidence. Let's look at what the data is actually telling us. When we examine the empirical picture, we see an incipient but highly incomplete recovery. It's definitely not a universal boom. Just look at this number. Gross non-performing assets have plummeted to 2.2%. This data point is huge. It powerfully confirms that the infamous twin balance sheet problem, where both corporations and banks were heavily stressed, has substantially eased. Impaired banks are just no longer the primary bottleneck holding back investment today. We've largely repaired the financial ability to invest. Bank balance sheets are clean. The dry powder is sitting right there. So, why isn't investment exploding across the board?
Well, a closer look reveals a really nuanced, selective recovery. Large, established companies generally have great balance sheets now, but they face uncertain demand and policy visibility. So instead of building massive new greenfield factories, they're using their retained earnings to pay down debt or issue dividends. Then, on the flip side, you have micro, small, and medium enterprises, or MSMEs, battling a completely different beast. They're starved for working capital and crushed by delayed payments, which totally stunts their ability to upgrade technology. Meanwhile, labor-intensive exporters are struggling with global trade access and logistics scale. So we don't have one single overarching investment problem, we have several localized, sector-specific constraints.
That brings us to section 3, demand and profitability gaps.
Since bank health isn't the main issue anymore, we have to dive into the core frictions holding back broad-based investment. Capital is notoriously cowardly, right? It's not going to move unless it can clearly see a profitable return. Consider this fundamental question. If consumption growth is heavily concentrated among a narrow, highly affluent segment of the population, why would producers of mass-market goods risk building massive new factories? We're seeing premium automobiles, luxury housing, and high-end services flying off the shelves, but mass-market demand is seriously restrained by informal employment, agricultural income volatility, and rising household debt. A firm invests in anticipation of future sales. If you're manufacturing everyday consumer staples and your target demographic's wages aren't growing, you're going to hold off on pouring concrete for that new plant.
Prominent economists heavily emphasize this exact point. The distribution and composition of demand matter just as much as aggregate GDP growth. Top-line GDP growth does not automatically equate to a massive, effective market that justifies capacity expansion. You can have a fast-growing GDP, but if the composition of that demand is highly skewed toward the top, it leaves a vast segment of the industrial base stuck with moderate capacity utilization. Think about it. If a factory is only running at 74% capacity, the owners don't need a brand new plant. They can just add a weekend shift or slightly tweak their existing assembly line to meet demand. And hey, even when the demand is there, projects often hit a brick wall of profitability gaps due to harsh execution realities. Notice this cascade of delays. A project might look amazing on paper, but then it gets bogged down in fragmented land titles or environmental clearance disputes. Every month of delay increases the interest you have to pay during construction, which mathematically postpones your revenue generation. This completely destroys a project's net present value, or NPV, before a single product rolls off the line. A perfectly viable project can become a financial disaster simply because it got stuck in a bureaucratic holding pattern for 3 years.
Which bleeds right into our fourth section, policy and financial risks. Because large-scale investment is largely irreversible, uncertainty creates an enormous economic incentive for firms to just wait and see. As highlighted in the economic survey, India's high hurdle rate isn't just about the baseline policy interest rate set by the central bank. The true cost of capital is severely compounded by all these hidden layers. You've got the lender tacking on a risk premium. Then come the stringent collateral requirements, heavy regulatory and compliance costs, and general paranoia over long-term project cash flows. When you add all these elements up, the expected returns on many projects fail to cross this elevated hurdle rate, even if the project is something the country desperately needs. And here's the kicker. This hurdle rate isn't applied equally. This stark divide reveals a critical fault line in the economy. Large corporations have a whole menu of financing options: retained earnings, equity markets, cheap external bonds. But MSMEs live in a completely different reality. They're almost entirely reliant on traditional bank credit, heavy collateral, and they suffer constantly from delayed payments by those larger buyers. They effectively face much, much higher interest rates. This is exactly why an aggregate increase in national credit can easily coexist alongside starved, stunted investment among smaller enterprises. The money simply doesn't flow evenly down to the roots. This insight really hits the nail on the head. India frequently faces an implementation deficit rather than a shortage of policy announcements. Announcing a shiny new multi-billion-dollar project means absolutely nothing if weak state capacity, lack of center-state coordination, and delayed clearances lead to stalled execution. Infrastructure projects are especially vulnerable here because they depend so heavily on long-term public contracts and land acquisition. If a firm anticipates an implementation deficit, they immediately price that legal and regulatory uncertainty into their financing costs, which, you guessed it, delays the investment even further.
Let's look at Section 5, the coordination failure.
This is a fascinating macroeconomic puzzle, the incomplete investment ecosystem. It's where we see how individual, completely rational decisions lead to a collective standstill. A manufacturing firm needs suppliers, reliable power, skilled workers, and export access all at the exact same time. But look at the reality of the ecosystem. Suppliers are waiting for the anchor firm to actually build the factory. Banks are waiting for proven, risk-free projects to lend to. Workers are waiting for the jobs to materialize before they invest time in specific skills. And the anchor firms? They're waiting for the infrastructure and the demand to be crystal clear. It's a giant standoff. Everyone is waiting for someone else to make the first move. This is why isolated tax concessions so often fail to ignite action. You can't just cut a tax rate and expect a massive factory to magically appear if the entire surrounding ecosystem is missing.
Finally, Section 6, Blueprint for Investment Revival. So how do we break this standstill? As economists, we need to translate this academic diagnosis into an actionable prescription. The ultimate objective of any macroeconomic intervention has to be triggering this exact self-reinforcing sequence of economic momentum. It all starts at the base, strengthening broad-based mass demand by raising employment and household incomes. That demand eats up the spare capacity in existing factories, pushing capacity utilization higher. Once those factories are running at 90%, profitability jumps. That profitability is what finally catalyzes the large-scale greenfield investment we've been waiting for. And what does that new investment do? It generates new employment and incomes, feeding right back into step one. That is the virtuous sequence we absolutely must architect.
To actually pull this off, policy cannot just hand out isolated subsidies. Production-linked incentives, or PLIs, are a great start for sure, but they have to be structurally integrated into complete ecosystems.
We need to combine financial incentives with aggressive supplier development, reliable multimodal logistics, domestic R&D facilities, and highly targeted workforce training. It has to be one seamless pipeline. If we only incentivize the final assembly of products, we just remain dependent on imported components forever. We have to build the entire value chain domestically to see true productivity spillovers.
And we absolutely must cure the asset-liability mismatch in the financial system. Commercial banks rely on short-term deposits, which makes it super dangerous for them to fund a 30-year infrastructure project. We need to expand development finance institutions that can handle patient, long-term capital. We need to deploy blended finance, like first loss capital, to de-risk green energy and emerging tech for private players. And at the grassroots level, we must strictly enforce MSME payment timelines to ensure smaller firms actually have the working liquidity they desperately need to survive and eventually invest.
As we wrap up this explainer today, I want to leave you with this final provocative thought. We spent the entire last decade painstakingly cleaning up bank balance sheets and ramping up public infrastructure. We have fixed the ability to invest. The money is literally sitting there. But the challenge of the next decade is an entirely different beast. It's about forging a durable, confident willingness to invest. It requires slashing policy uncertainty, building complementary human capital, and unlocking that elusive mass demand. How quickly we can solve that specific equation will entirely dictate India's macroeconomic trajectory on the global stage. Thank you for joining me for this deep dive. Keep questioning the data, and I'll see you in the next explainer.